I'm Motley Fool Canada Senior Analyst Dick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing a Canadian dividend stock on our radar this month, that being Intact Financial. The ticker is IFC on the Toronto Stock Exchange. My guest today to help me do that is Motley Fool Canada Chief Investment Officer Ian Butler. Ian, thanks for joining me.
Fantastic to be here as always, Dick.
So, the question on everybody's minds, Ian, why Intact and why is it an attractive Canadian dividend payer right now?
For sure. So Intact Financial, many people recognize the name, many people won't. So it's a long time recommendation of our flagship stock advisor Canada service, and it is Canada's largest and arguably best property and casualty insurance company. About the only problem I've had with Intact over the years is that the stock price seldom pulls back, creating an opening for one to either begin or add to an existing position. However, now is one of the rare moments where it has pulled back. The company is just fine, as evidenced by reported book value per share that's up about 14% year over year in its most recent earnings. Operating return on equity that clocked in at about 20%, which demonstrates the compounding engine here certainly continues to hum. However, since July, the stock price is down by about 15% for, as my colleague Jim Gillies likes to say, reasons. We don't know why. I don't think anybody could come up with a good excuse. But we have pulled out our soapbox to proclaim to our Stock Advisor Canada members that right now is a great time to be buying Intact. And here is why. To be clear, we're not talking about a situation that's going to go to the moon overnight. This is not some speculative little mining stock. This is a high quality, very high quality company trading at a fair price. And these are the kinds of things that you just buy and own and let them sort of cook away in your portfolio. So with Intact, the components of return can be threefold. Dividend stock, as broadcast off the top, with Intact currently yields about 2%. That is money good. And this is a company that consistently raises that dividend. So if you have it paid out about $5.20 per share over the past 12 months. If you bought Intact shares 5 years ago, that would be an effective yield of about 3.5%. So that's the kind of thing that's going to happen over the next 5 and 10 years for Intact's owners. So 2% dividend yield, that's going to grow. We can then consider the history of growing the business. Intact has done a wonderful job over the past decade, growing its book value per share at about 10% on average. And I think that's as good a guess as any as to what the company is going to do over the next 10 years. So we've got a 2% dividend yield that's growing, company growing at 10%. You're going to fall out around a 12% annualized return from the stock just on those two components. And then we consider the multiple. Intact's 10-year average price to book multiple is about 2.5. Stock currently trades at 2.5. It's traded as high as 3.25 times book value. It's traded as low as 2 times book value over the past decade. So there might be some variability in the multiple, but in this case, we're gonna just kind of exclude multiple expansion or contraction from the equation. And we're going to call this a stock that's going to provide a really low risk 12% annualized return for as long as anybody owns it.
Yeah, so you talk about risk here. Obviously, the insurance business, you're in the business of pricing risk. And if your things could work out and those risks don't materialize, you can have good results. If you have bigger than expected losses in your insurance book, things can potentially go sideways. So if you look at Intact's business as an insurer, what are the main risks or potential watch items to monitor that could disrupt that 12% return profile that you laid out?
For sure. So, I mean, I think again, we've put this forward over the past decade. I think the company's seen every risk imaginable over the past decade. So we're talking natural disasters. It's an acquirer, so there's acquisition risk that comes along with it. It's done a fantastic job integrating acquisitions over the years. We don't see this changing. And then there's always stuff like reserve adequacy that impacts insurance companies in general. So to me, the biggest risk is that you buy it today, you don't take a big enough position, and the stock just keeps marching higher as it has over the past decade, and you sort of fail to fill up the tank with a big enough position or as big a position as you should. That's the kind of company that we're looking at. So again, low risk, despite there are risks, but the company's seen it all before, and I don't think this is one that you're going to think about again after you buy shares today.
All right, that's Intact Financial for you. Just a reminder on that ticker, that is IFC on the Toronto Stock Exchange. Thank you for joining us for this edition of the 5 Minute Major. Reminder, if you want more stock ideas from us, click on the icon in the upper right corner. Until then, We'll see you next time, and Fool on.